Welcome to Chapter 9 of Fundamentals of Financial Accounting. Before we dive into the chapter, make sure you have the blank file downloaded and printed from SFU Canvas. A receivable arises when a business or person sells goods and or services to another party on credit. In other words, on account. This can also happen when money is loaned from one party to another. A creditor is a party which sells something and obtains a receivable, which is shown as an asset on the balance sheet. A debtor is a party which makes the purchase and has a payable. This is shown as a liability on the balance sheet. A receivable is considered to be close to cash, but not cash yet. There are advantages and disadvantages to selling on credit. The major advantage is it tends to increase sales because it is easier and more convenient for buyers to make purchases. This boosts the business's sales and net income, but also presents a risk. Customers might pay for their purchase later than expected or not at all. So we have to be careful. We can sell on credit, which is kind of an incentive for customers to come shop with us. We also have to be able to collect most of the money that's promised to us when we make a sale. So make sure you have the proper checks and balances and emergency measures in place to get the money that you're owed. So we have different types of receivables. The most common one, which we have seen several times already in our course, is accounts receivable, also called trade receivables. These are amounts to be collected from customers. Accounts receivable are classified as current assets. The AR in the general ledger serves as a control account because it summarizes the total of the receivables from all customers. So we saw this in Chapter 7. It is a common practice to maintain a subsidiary ledger of the receivable from each customer. So you want to keep track of who owes you what, when they're paid, and so on and so forth. Those details are very important. You don't want to miss out on amount owed to you, and you definitely don't want to harass your customers when they've already made the payments. Notes receivable. These are more formal than accounts receivable. The debtor promises in writing on a promissory note to pay the creditor a definite sum at a future date, called the maturity date. Notes receivable due within 1 year are current assets. Notes beyond 1 year are long-term assets. So with notes receivable, they can either be current, so they're due within the next year, or they can be a longer term investment or asset where you expect to collect the money later on, beyond 1 year. Other receivables, this is a miscellaneous category that may include loans to employees. These are usually classified as long-term unless due within 1 year. Accounting for uncollectible accounts, also known as bad debts. For review, let's look at a journal entry for service provided on account. So debit is to AR for 1,000, and service revenue is a credit for 1,000. So you do some work, the asset that you get is AR, and the revenue record is service revenue. Later on, when cash is collected from the customer, we reverse the outstanding receivable with the following entry. Cash, debit of 1,000, AR, credit of 1,000. So when you collect the cash, the AR goes away. What happens if the customer doesn't pay? This question brings us back to the fundamental issue with selling on credit. How do we record uncollectible amounts? So we're going to look at something called the allowance method. We use a contra account to AR called allowance for doubtful accounts, or AFDA, to create a contingency for uncollectible amounts. The way this account works is as follows. 1. We estimate for how much bad debt might occur next period. This estimate can be based on several factors, such as the amount of expected sales revenue generated on account, percentage of bad debt experienced historically on his receivables, and perceived creditworthiness of current customers. The allowance for doubtful account is credited for the estimate amount. So the analogy I like to use here with my students is the EFD account is kind of like a bucket of water. So in the step 1, when we make a credit to that account, we're filling up that bucket with the approximate amount of water that we need to put out fires later on. And you're going to see that in step 2 and 3. Each time an AR balance is deemed uncollectible, customer says they can't or won't pay, or there's a bankruptcy filed, or the customer just simply ghosts you, or a whole multitude of other reasons, we debit the AFDA for the amount of the bad debt. Note that this method follows the matching principle in the sense that the sales revenue and its corresponding bad debt expense are recognized in the same period. So this is where we get to the fire part. Each time a customer can't pay their AR balance, it's essentially a small fire. So you filled your bucket up with a little bit of water, or the appropriate amount of water that you think you need, and every time a small fire pops up, you take a little bit of water from the bucket and you put out the fire. And this works well because the sale that you made on account probably happened a while ago, right? Before you can actually realize that the customer can't pay. So because the sales revenue happened a while ago, the bad debt expense is also recognized a while ago. So they kind of match up. You fill the bucket of water, that's the moment you recognize bad debt. Step 3, at the end of the reporting period, or earlier if necessary, we make adjustments to the AFDA. We should also consider the latest period information in our future bad debt estimates, since circumstances may have changed from past periods. Let's use SFU Bookstore as an example again. Assume the bookstore has $3,000 worth of accounts receivable at the start of quarter 2, and the bad debt expense is estimated to be the same as its historical rate of 1% of AR. The net accounts receivable balance is, so we have 3,000, which is the gross amount of money that's owed to us, and then we have an estimate that goes into AFDA of 30, and therefore our accounts receivable net value is 2,970. So note that this amount up here, the 3,000, is a debit balance. This 30 is sitting in our bucket of water or AFD account as a credit balance, and this final number is also a debit balance. Hence, The bookstore estimates that it will not collect $30 of its receivable balance. The net realizable value, or NRV, of the accounts receivable is $29.70. Usually, only this value is reported on the balance sheet, since the AFDA amount is negligible anyway. There are three ways to estimate uncollectibles or bad debt: percent of sales method, aging of AR method, and the percent of AR method. Starting with percent of sales. This method computes bad debt expense as a percent of net credit sales. This method is known as an income statement approach because it focuses on the amount of expense. Jumping into an example here, assume the bookstore bad debt expense is historically 2% of net credit sales, which were $10,000 in 2009 with no collection made as of yet. Before the year-end adjustment, the AFDA has a credit balance of $50. The adjusting entry to record bad debt expense for 2019 and update the allowance is. So I'll stop the video here and give you a chance to work on this. We'll continue in the next video.